Navitas Semiconductor Corp is currently trading at $7.45 USD, down 0.10 points or approximately 1.32% for the day so far. If you are watching the ticker tape right now, you might see this downward movement and assume it is just another sluggish day in the semiconductor sector, or perhaps a continuation of the bearish trend that has plagued this stock over the last month. That is the expectation, that this is a company struggling to find its footing after a disastrous earnings report. The red numbers on your screen, whether you are checking via Fidelity mobile app or glancing at your Robinhood app, seem to confirm a narrative of weakness. But the reality? The reality is significantly more complex and, frankly, far more interesting than a simple percentage drop suggests. What looks like a bleed out to the casual observer might actually be one of the most aggressive strategic pivots we have seen in the chip space this year. While the market is punishing Navitas for its past, specifically its reliance on consumer electronics, the company is quietly betting the house on the future of energy infrastructure and artificial intelligence. This disconnect between what the price is saying and what the company is actually building creates a massive tension, and that is exactly where we need to focus our attention today. Let's strip away the noise and look at what is actually happening on the floor. The volume today is hovering around 1.6 million shares, which is notably lighter than its average volume of over 45 million. This tells us something crucial. The aggressive selling pressure that decimated the stock earlier this month, driving it down over 50% in mere weeks, is starting to exhaust itself. When volume dries up on a down day, it often signals that the sellers are running out of ammunition. We aren't seeing a panic exit today. We are seeing a standoff. On one side, you have the frustrated retail investors who bought into the hype of Tesla stock or NVTS stock and thought Navitas would ride that same immediate wave, only to be disappointed by the recent earnings mess. On the other hand, you have institutional eyes watching the consolidation. This $7.45 level isn't just a random number. It is becoming a battleground where the market tries to decide if Navitas is a value trap or a coiled spring waiting for a catalyst. Now, let's address the elephant in the room: the expectation that Navitas is just a mobile charger chip company. If you have been using Schwab Intelligent Portfolios or reading generic online investment articles, you might still classify NVTS as the company that makes your phone charge faster. And if that were the whole story, this stock would deserve to be lower. The consumer mobile market is saturated, margins are tight, and growth is slowing. That is the old Navitas. The new Navitas, the one emerging from the ashes of this month's 55% crash, is entirely different. The company is aggressively pivoting away from low-margin consumer tech and steering the ship directly toward the high-voltage, high-stakes world of AI data centers. This isn't a subtle shift, it is a complete reinvention. The recent $100 million private placement wasn't just a cash grab to keep the lights on, it was a war chest to fund this transition. When a company deliberately sacrifices short-term revenue by exiting the mobile market to chase long-term dominance in a booming sector like AI, the stock price almost always takes a beating initially. Investors hate uncertainty, and they hate revenue drops. But for those who understand the physics of the semiconductor market, this is a classic J-curve scenario: short-term pain for potential exponential long-term gain. Before we go further, I want to know where you stand on this transformation. Comment below how many shares of Navitas you currently hold, and let me know, do you trust management to pull off this pivot to AI, or do you think they are abandoning their core business too soon? I want to see what the sentiment is down in the comments section. To really understand the opportunity here, we have to get technical for a moment. Not in a boring academic way, but in a "why does this matter for my investment" way. Silicon, the material that has powered Silicon Valley for decades, is hitting a physical wall. It simply cannot handle the power density and heat generation required by next-generation technologies like NVIDIA's latest AI GPUs or the rapid charging infrastructure for Tesla stock and other EVs. This is where gallium nitride and silicon carbide come in. Navitas is a pure-play leader in these materials. Think of it this way. If silicon is a standard gasoline engine, GaN is a high-performance electric motor. It's smaller, faster, and vastly more efficient. The recent news that Navitas has partnered with global foundries to accelerate US-based GaN production is a massive signal that the market is largely ignoring today. This partnership ensures a secure, compliant supply chain, something that is becoming non-negotiable for US tech giants and defense contractors. While the market frets over a quarterly earnings miss, Navitas is locking down the manufacturing capacity to power the grid of the future. Let's talk about that earnings miss because it is the reason the stock is trading at $7.45 and not $15. In Q3 2025, Navitas reported revenue of $10.1 million, missing expectations. They also missed on EPS. The algorithms that run SoFi Invest portfolios and Interactive Brokers trading bots saw miss and immediately sold. It's a reflexive action. But why did they miss? They missed because they are deliberately turning away business. They are deprioritizing the mobile market in China, which is high volume but low profit, to free up resources for the high-power AI and industrial sectors. This is the expectation versus reality dynamic in its purest form. The expectation was steady growth in their legacy business. The reality is a strategic contraction to enable a leap forward. It's like a runner taking a step back to get a running start for a jump. The market only saw the step back. This brings us to the broader ecosystem of online investing. If you are sitting at home managing your own individual brokerage account, perhaps using Fidelity investments or even just dabbling with Robinhood fractional shares, you are constantly bombarded with noise. Buy this, sell that, this sector is hot, that sector is dead. It's exhausting. The key to successful self-investing is differentiating between a broken company and a broken stock price. A broken company has no product-market fit. A broken stock price is often the result of a misunderstanding. Navitas is arguably the latter. The demand for power efficiency in AI data centers is not a maybe, it is an absolute certainty. AI factories consume gigawatts of power. Every watt saved by using a GaN chip instead of a silicon chip translates into millions of dollars in savings for the operator. Navitas has the technology, their GaNFast and Gen-C chips, to deliver these savings. The disconnect is simply timing. The revenue from these new AI design wins hasn't hit the books yet, but the lost revenue from the mobile exit has. We are in the gap. The recent insider and institutional activity is also telling. While the stock price has cratered, we saw the $100 million private placement get filled. Who puts $100 million into a dying company? Smart money does. Accredited investors and institutions don't write checks that size unless they have done deep due diligence. They aren't looking at last quarter's earnings. They're looking at the 2026 and 2027 roadmaps. They're looking at the partnership with global foundries. They're looking at the sheer physics of GaN versus silicon. If you are using Interactive Brokers to track institutional flows, you will see that while some funds have trimmed, the core long-term holders are staying put or adding. This is a high-stakes game of poker, and the folks with the best cards are not folding just because the flop didn't look pretty. Let's shift gears to the macroeconomic picture, because no stock trades in a vacuum. The semiconductor industry is currently navigating a complex landscape of trade restrictions, supply chain onshoring, and interest rate sensitivity. For a growth company like Navitas, interest rates matter. Higher rates make their future cash flows worth less today, which hurts their valuation. However, the tide is turning. As central banks signal a potential easing cycle, the pressure on growth stocks like NVTS could alleviate. Furthermore, the geopolitical push for energy independence and chip sovereignty plays directly into Navitas's hand. By cementing a manufacturing footprint in the U.S. with global foundries, they are insulating themselves from some of the China-U.S. trade risks that plague other semi-stocks. When you're browsing investing sites or looking for investment help, it is easy to overlook these geopolitical moats, but they are critical for long-term viability. For those of you who use SoFi Active Investing or similar platforms, you might be wondering about the technicals. The stock is currently sitting near its 52-week lows. Technical analysts would call this oversold. The RSI on the daily chart has been screaming buy for a week now. But be careful, oversold can stay oversold for a long time. The key level to watch is $7.00. If it holds $7.00, we could see a double bottom formation, which is often a precursor to a reversal. If it breaks $7.00, the next support is significantly lower. This is why risk management is paramount. If you are using Robinhood